It's going to open somewhat flat. The Dow is giving up some gains. The NASDAQ is gaining a little bit. So we'll see where it settles down and see what the market's going to do. It's been an up and down week. Part of the week we spent with some stocks going up, and then especially yesterday, some stocks really gave up gains. And we continue to see a rotation from certain stocks in certain sectors, certain industries, and out of those and into some new ones, which is good. In general, I am building up some cash, and the reason for it is we've been on a very, very good upward rise, which is great. When we see this type of chart for the 5-year, it's been a really, really nice period of time to grow wealth, to really stick to stocks and see your wealth grow. So it's been a really, really good 2.5 years, call it. But the party is going to end. There'll be a correction. There'll be a substantial correction at some point. There'll be some pullbacks as well. Is 2025 going to be that year when it's going to happen? I don't know. But I don't want to be caught with no cash, available to invest, to weather a down period, a drawdown like we had in 2022. So I'm building up cash, and I'm beginning to slice off some shares off of some of the stocks that I have really good gains on, and will continue to do so. And we'll see where we end up. I think the market, the way it's behaving, it kind of, tells me that I'm not the only one thinking that way. If you look at like the sell-off in Palantir as an example, in Robinhood, you're seeing a pretty quick, sell-off. And I think that's the case. Meta's been doing great, but for 2 days, it's given up a pretty good amount, maybe about 5% over 2 days. Collectively, it was on a 20-day win streak. It's just going up and up, and it's great to see that. But at some point, it just gets too expensive. Stocks get too high, and when stocks get too high, corrections are needed. So that's what I'm seeing out there. Looks like we have a lot of people on, and I appreciate it. Thanks for joining. Looks like Codis CAD, congratulations on that bonus, man. Omar, good morning. Android PC, good morning. Shadow Guy, buenos dias. And thanks for joining. Lighter, morning. What's up, man? Akil Elias. Yeah, I can look at Oscar. I will definitely look at Oscar. How about Shift4 Payments? So the symbol is 4. Yeah, I can look at that. I don't think I've ever looked at that stock. And Kiter, good morning. How are you, sir? Tomas, buenos dias. How are you, sir? Hopefully, Tomas, Mercado Libre stock is brightening your morning. Lighter, you think Oscar is a buy? Yeah, I agree with you. I will take a look at it. David, thanks for joining. Really good to have some new names out there. It's very good that you're joining the live stream. So the format of the live stream, I'm going to have some opening comments just to kind of try to recap the week and share with you what I'm seeing, what I'm doing with my portfolio, and then get into looking at some individual companies, and we'll go as deep as necessary. Some stocks are kind of really interesting, and I could do a full deep analysis on them. In some cases, I'll have it ready so I can take a look at it. I value companies on cash flows and earnings per share for the most part. When it comes to banks, I just go on earnings per share and book value. When it comes to REITs, I only use the earnings per share as an example, but 80-90% of companies fit into a discounted free cash flow model, which I follow, and I created my own. So I'll use my tools and get some information online for that. So if you have a stock you want to look at, looks like a few of you have put some stocks out there, and I'll cover them. So it looks like, I think it's Media. Good morning. Thoughts on Block? Yeah, I haven't looked at Block in a long time. And yeah, it's been a while. It seems like Block, and which was previously Square, and PayPal both kind of got taken down around the same time, and they both have struggled to get back to their previous all-time highs. It looks like, David, you want to look at two stocks that I had already planned to cover. So United Healthcare, they had a big drop because they're going to get investigated. And then Coin, the opposite. I think the SEC is going to drop some type of tension they had with Coinbase. So I wanted to look at that one too. So we'll look at both of those and keep them coming. I've got a couple hours to spend with you this morning. We can watch the market open and see what it's going to do today. So just taking a look at the heat map, although it's kind of difficult to understand at times, like what the heck's this market doing, I think it's healthy to have a rotation out of Meta, Google, Tesla, Amazon, and into other sectors, because certain stocks have gotten really expensive. And the boxes here, the bigger the boxes are, that means they're a greater portion of the overall market cap of the stock market as a whole. So you can see some of these boxes are really big. So a lot, like Apple is the most valuable company publicly traded in the US. Well, if Apple really, rises or falls, it really moves the exchange. So these stocks, they've been rotating out. Even the great NVIDIA has kind of been flat for 7-8 months, but we saw some real deep red here. For some reason, cybersecurity was really giving up a lot of gains, and as well as Palantir. CRM gave up some gains, which was an opportunity. ServiceNow, banking and credit cards, really red yesterday. Walmart had a down day. Their forecast going forward is they believe the consumer is not going to spend as well as they did maybe in 2024. That inflation is beginning to affect the consumer. They're not going to be able to spend as much money on product over at Walmart. So their forecast for growth wasn't very good. So the market sold off Walmart. That's a big cap. So it really affected Walmart as well as the stock market. Looks like it brought down Costco a little bit, and as well. The sectors that worked, drug manufacturers did well. I think there was an announcement that the U.S. may put tariffs on imports of drugs and pharmaceuticals. So that's going to help that industry. United Healthcare was down yesterday, and it's going to be down a lot today. Man, that company cannot catch a break. Excuse me while I sip my coffee. It is early on the West Coast. So moving on. So it looks like healthcare is kind of bouncing back. Energy did well yesterday. Looks like oil prices did rise. So this has kind of been a little bit of a green spot for the market. But there's substantial red out there. And again, I don't hope for like terrible days on the stock market, but I'm also realistic, right? As I get older, think about this, which is, you grow wealth and you're like, great, I want to enjoy it, right? I want to take awesome trips with my wife. I want to be comfortable and so forth. So I begin to think, well, if there's a substantial crash, because I've lived through a couple of good ones, like the one we had in 2022 was about a year of seeing stocks go down. So it was, I'm going to call it frustrating / tough, but it opened up opportunities to buy into great companies. The crashes that were really concerning were first COVID, right? When COVID hit, the market sold off fast. Like in 30 days, it was down 35, 40%. That was scary. The other one was bad was the Great Recession, which was led by the subprime market in 2008, 2009. And during those periods, when you see your hard-earned money, you've been saving up for a couple of decades and you have a substantial amount and it shrinks by 30%, it really gets to you. And as I get older, I'm like, I'm okay going through a correction or a crash and having the next 5 years, off the table. My quality of life, I'm going to have plenty to invest with for the next 5 years. That's my mentality. That's why I'm getting into cash. Just kind of de- uh, managing risk, making sure that, if the market does decide to correct, I'm going to be ready for it. But I'm still, as you'll see, if you know my portfolio, if you watch my streams and watch my videos, or even if you're a member and you attend the weekend calls, a big portion of my portfolio is on growth stocks. And if anything, it's just really interesting to invest in companies that are really successful. I mean, who wouldn't want to be part of success? So, so I don't think that's ever going to be absent in my portfolio. I'm still going to be in exciting companies. I just continue to go into maybe making bonds and cash a greater portion of my portfolio instead of being 90% into stocks, grow, a greater portion of bonds. So that's what's going on in my head, a kind of mentality long term. When we look at sectors, for a while, consumer communication services was on top, but now materials is looking like the sector of stocks that's doing the best so far in 2025. And these are companies that are benefiting from the tariffs on steel. They're also benefiting from an appreciation or a higher commodity price on copper, gold, silver. Those precious metals have been doing really well. So materials is looking pretty good. I'm not in any materials companies. I'm trying to research them and see if there's a good one out there. I might even get into an ETF because I don't feel like I have the expertise, the insight, the intuition to invest well in that sector. But inflation's picking up and these commodities are going up in value and price. So it might be a good place to throw a few bucks at. And it is somewhat, I always think that materials are going to do well in a booming economy, but here we are. I don't think the economy's booming. I don't think we're in a recession. We're just kind of like in between the two, and materials are doing really well. Communication services is still doing well for the year, but they're kind of seeing a little bit of a losing streak. Meta's down for 2 days in a row. I don't think Google's going to have a great year. I'm a big Google, the Alphabet stockholder, but I think their strategy, they need to revisit it. I still think the market disliked how much capital they're spending on that data center. And they may think they're doing something good long term, but the market likes to see metrics, fundamentals, and they like to see that they're going to make lots of money over time. And at the end of the day, your report card is in financial figures. It's not in look how cool our data center looks. So hopefully Google Alphabet reads the writing on the wall and corrects their strategy. Healthcare has been moving up. They're up to the 3rd spot. Energy is doing well. Utilities are right there. And everything's in the green, but that's the pecking order so far based on sectors. What types of companies are doing well, which ones are doing the best, which ones are doing the worst. So when we look at the big cap stocks, these guys represent, the top 10 represent 40% of the S&P value. So these guys really move the S&P. Apple is in the red for the year. It had a decent day yesterday, considering that the market was the index as a whole was down. Nvidia was up a little bit. Nvidia's doing pretty good. I've seen them kind of rally year to date, up 4%. And they have a huge earnings announcement next week. That I'm sure is going to, I don't know what's going to happen, but it's either, I don't think there's a lot of upside potential on Nvidia, but I think it could certainly drop. I just don't see that. You're already valued at 3.4 trillion. How much good news can you put in that earnings? And if you are seeing kind of a pullback in that data center, are you going to need to report it and say, hey, in a year, we don't know if we're going to be able to grow as fast as we would like? We'll see. I think they'll have to announce it, and we'll see how the market takes it. Microsoft's in the red for the year. Amazon is in the green for the year, but it had a bad day yesterday. Google, red. Meta, red yesterday, good year so far. Tesla is in correction territory. Broadcom, red. So there's a substantial amount of red here for the day yesterday, and we'll see if it continues going forward. So we had some pretty good announcements there, but they've kind of faded a little bit. This is from yesterday. Walmart was the biggest player. They're a big cap. And the other bit of news that came out that's interesting is that Amazon surpassed Walmart from a revenue perspective. And that most definitely is a date in history, right? That Amazon is now bigger than Walmart. And I think Amazon's business is far more profitable and valuable because not only do they do e-tailing, which I think is more lucrative than retailing, but they also have their cloud business, and they have other businesses like their video streaming business and other things that are quite valuable. But Walmart's still Walmart. They're massive. They're big. They also have their Walmart website. So they were down yesterday. Alibaba enjoyed a very good day yesterday. We'll see if the rally continues in Alibaba. Booking, I haven't looked at Booking. I think they've been performing really well, and I own their direct competitor. So I tip my hat to the competition there, which is these guys have had the better strategy and they've executed better. So that is interesting. Mercado Libre announced after the close, and they had a very good announcement, and their stock is up. The one stock that is down is New Holdings, which is kind of weird because I thought their earnings were really good. But the market's selling it off. I think the market might be nervous that the Brazilian currency is really down, and that could obviously affect New Holdings' overall, performance and the condition of the company and their economy and all that good stuff. So yeah, I get that, but New Holdings can't control the overall Brazilian economy. But what they can control is to continue to execute on their strategy. And they certainly did so. They added so many new customers, which was awesome. And they grew. So I'm sticking to New Holdings. I'm actually going to buy some more shares. So yesterday was a big day. A lot of announcements. Even had Live Nation out there. Vici Properties. That's a good REIT. And just a bunch of others. Sprouts was out there. Man, that might be cool to look at. Sprouts has been, it's a grocery store, food retailer, and they've done really well. They've outperformed, I think, everybody else in that category. So we'll take a peek at that one. Rivian, I heard, did well. They've announced that they're going to be profitable. So go Rivian. And somebody asked me about Constellation, and I think it was on one of my videos, or I forgot which platform. Maybe it was on Discord, and they said, "Hey, what do you think about Constellation and Warren Buffett buying into Constellation?" I said, "Hey, I prefer not to buy into beverage companies, and principally because you see Coke here, they've been around forever, and their market cap's 12.64 billion, right? So they just don't become this massive value company like an Amazon or a Meta. So I'd rather try to find a company that's going to become that really, really valuable company. In Unity Software, I heard a lot of noise there. So we'll take a look at that one. I heard they announced, and there was one more that just broke the internet, so to speak. It was up like 30%. Celsius. Okay. An investor on the Discord is a Celsius stockholder. And I think he was pretty happy about them. All right. So thanks for joining. I see some new people have come in, and Shadow Guy. Wow. So, and I'm going to pronounce it wrong. So let me put it on the board here. So evaluate. Yeah, we can look at that one. I'm not even going to try to pronounce it. Sorry. It looks like if you had this word in Scrabble, you know, the company name, boy, you'd probably score big. So we can take a look at that. So lighter Lenovo rallies, really? Yeah, okay. Our PC sales up. Take a peek later. So Blade, do I follow politician trades? I don't follow them like religiously. I probably are more influenced by super investors, and I don't follow super investors like religiously. I try to find companies that I can understand, that I feel like I have a really good ability to make a good decision within that industry. I value them from the ground up, like look at their cash flows, understand their earnings per share, and then determine my own valuation, and then look for outside kind of bits of information. Like if a super investor is also invested in a company that I think is a really good company to buy, or I hold the company and I think, hey, that stock's really good. And I see other or I should say, I see super investors are invested in that company. That's encouraging. That's like, all right, cool. Politicians as well. Like if I see that, hey, this politician's buying to this company, they probably know stuff that makes them be optimistic. They're like, hey, we know that, like, for example, Coinbase, right? The SEC is dropping some type of litigation against them. Well, if a politician knew that was coming, they maybe could have bought into Coinbase, and they get away with insider trading. It's not a law that they're not punished like a normal citizen would be. And that's just the way it is. So I don't follow politicians religiously. I think it could throw off my recipe for success, which is try to get to great companies, buy them, hold them, make a very good appreciation on those great companies, know when to sell companies and so forth. But it's the base is trying to understand that company, their industry. Are they strong? Are they weak? Are they desirable? Do they have moats? And that type of analysis. So yeah, so Blade, Walmart did go up quite nicely last year. I think they were up like 70% or something, but we'll see how they do this year. Retail is tough, but Walmart knows how to do it. They are the biggest retailer in the world. All right, so I'm going to start with a company that's going to be easy to cover because I've been covering it for a while, and that's going to be United Healthcare. So United Healthcare is going to drop 12% when we open here in about 6 minutes, and they have not had a good year so far, and the year not very good. But this stock has really been a winner for a long time. I was a long-term United Healthcare stockholder, and I got out of the stock like around this time, and I switched to Elevance, but reduced my position. It was a very good investment for me in United Healthcare. I did really well with it, but then I moved on. And I didn't think they were going to have, especially the last 6 months. I mean, having your CEO assassinated is horrible. And now they're being investigated for their practices with regards to Medicare. So they're going to have to contend with that. And if anything, it's just going to be bad press. So it's really bringing down the stock. Now, do I think that all is a good opportunity for United Healthcare? Potentially, but it's still a massive cap company within this space. This is a healthcare insurance payer. They're $462 billion. And I think I get a better risk reward situation with Elevance Health, or looking at some young players, some little players too. Oscar Health. This one here has come up recently in my radar, and I think it's a really, really neat little company. And they're up 20, almost 20% for the year. They're going to open up in the green. And they really came down here in February 13th, and they looked really good. Their results were very positive, and the market was really selling them off. I think the market was selling off healthcare. For the 1 year, this stock hasn't gone anywhere, but it's a small cap, $4 billion, revenues $9 billion. These guys try to focus on selling healthcare insurance to individuals and small businesses. And that is a category the big companies like United Healthcare don't want to touch. So they leave that market to players that want to operate in it. So I think there's a lot of addressable market for Oscar in that space. They are only a $9 billion company, where United Healthcare is $400 billion. So Oscar has to get, 5 times as big to get anybody's attention. And I think if they are very successful, they'll become an acquisition target, because that's what these companies do. Like United Healthcare has grown through acquisition. So has Elevance. So has like CVS. They acquired Aetna. So once you get bigger, you get acquired. Well, as an investor, I'm like, hey, that's a good idea. That's a good investment. Forward P is only 21, which is good. Analysts think it's discounted by 34%. The things I like about Oscar is starting with their growth. Their growth is very good. Their revenue growth, showing that, hey, they are successful in selling their product to individuals and small businesses. And again, I think it's a very big addressable market. And health insurance is one of those things where people are going to buy it. We value our health. We want health insurance. So if we get sick and have to go to the hospital and there's a $50,000 bill, we're not paying $50,000. We're paying like our co-pays and so forth. Maybe we're out of pocket $2,000 and the insurance company covers the rest. That's why you buy health insurance. I think most people value that here in the United States. And so Oscar is doing really well in acquiring new customers, growing their business. That looks really good. And when we look at their earnings per share, they went from being unprofitable, kind of startup mode, and now they're profitable. So that's kind of a very important milestone for a company. Free cash flow is very good at $950 million. Again, they've had some negative years in the past, but now that they're bigger, have greater scale, ability to generate cash flow. Now, having been an investor in healthcare companies for a long time, like United Healthcare, these companies generate free cash. The reason why these guys have a market cap of $462 billion, and that's a suppressed number. They've been, selling off for about 12 months, is that they generate free cash flow. This is why they're worth that much money. And if you look at the most valuable companies, this is one consistent attribute, is free cash flow generation. So Oscar is this, it's almost like, you look at a tree, and the tree that's been there, let's say you go to the redwoods in California, and this tree is 200 feet tall, and you're like, wow, this thing's awesome. It's 50 years old. Look how big and awesome it looks. And Oscar is kind of like a little redwood tree that's was planted 2 years ago. It's maybe 20, 25 feet tall, but I really see the attributes that are going to make this one of those big giant trees at some point. And this cash flow milestone is one of them. Once you reach free cash flow status, it really becomes a value generator. And if they grow that free cash flow, this company is going to be worth more. So I want to buy into this stock, and they already announced on February 4th. So we're not going to see an announcement for a couple months. But that I really like about Oscar. So when we look at what analysts are saying, 8 analysts cover it. And they, on average, when you take all their opinions and price targets, the average discount is 34%, which is very good. I'll look at how they're supposed to grow. So it looks like the revenue is this year. I don't have a revenue growth number, but I would be surprised if they don't grow here. And then it's supposed to flatten out here, which is kind of a surprise. That is a surprise there. When I look at Oscar and I do free cash flow and I discount that free cash flow forecast, and I'm looking at, cash flow not being as great as it's been, it looks like it's been for the last 12 months, actually bring it down by 15% in the first 4 years, just to tame the forecast and not be overly optimistic. They discounted by 11%, which is 3 full percentage points higher than what it would use for like an Elevance. I still get this cash is going to be worth 82% more than the current stock price. So that's really attractive to me. I'm trying to get into Oscar. Now, I'm just going to have to bite the bullet and get in because the stock keeps going up. And I hate that when I find a company and it starts flying up, but there you have it. I guess people are waking up to Oscar and buying it. Looking at where the stock is trading today, it's trading up just a little bit, almost 1%. Over the 5-day, it's up 17%. So we found this stock. I think this came up on a live stream and we started to beat it up. And I'm like, man, this is a really good company. And it happened right here. And I didn't pull the trigger. I like to, analyze a company, sleep on it, analyze it again, make sure, okay, everything looks good. And I didn't buy shares. So shame on me. I'm going to have to pay a little bit of a premium, but I still think it has a lot of upside. And hopefully it really rises. The one thing that is comfortable is the market hasn't been pouring money into the stock. Now, a part of it, I would say, is industry related. The industry of healthcare payers, they haven't been doing very well for the last 12 months. United Healthcare, I showed you that, which is over the past year, this stock is down 13%. That's the leader of the pack. So the whole industry has been down, but this company is really growing. They have great fundamentals. So this guy here is going to be a part of my portfolio, and I'm just going to have to bite the bullet and buy into it. I dollar cost average anyway. I think this one here, if they just keep executing on their business plan, keep growing, I'm optimistic this one's going to work. So that is Oscar. It looks like Mike has a comment on Oscar. Let's kind of read that comment. You've been trying to get into Oscar. Yeah. That's the problem with good stocks is they keep going up. It's like, can't you wait till I buy shares and then you go up? CVS has really been working well. Elevance has been okay, but CVS is the one that's been working. And I'm an investor in CVS and Elevance. So, yeah, I guess I'm just going to have to pay the price on Oscar and just get in there because I'll feel like a total turkey if the stock rises another 20% and I still haven't gotten in. I'll be like, you knew the company was good. Just buy this stinking stock. All right. So Danco, Let's read this comment here. Newbie. It's a very good question. So PE, I'll use an analogy, right? Like when you look at sports cars, and back in my day when I was a youngster, I'm 56. So when I was 20, right? You'd look at a sports car and go, "Whoa, that Porsche goes 160 miles an hour. Oh, the Lamborghini it was tested at 200 miles an hour." It's kind of a metric. Okay, that's how fast the car goes. In stocks, it's the opposite. We want the lowest PE. So when you look at an Oscar and you see a forward PE of 21 and you go, interesting. What's the leader of the pack? Their PE is 14. That's a bigger one. And I meant to go to a very high PE. We're going to go to AppLovin. AppLovin is 67 PE. And what that means is price to earnings. So the stock price over earnings. So this stock price is 67 times the net earnings, net profit of AppLovin. Now, when we look at AppLovin's revenue growth, it's 43%. When we look at Oscar's growth, it's 56%. So I'm seeing better revenue growth in Oscar than in AppLovin. Two different industries, but I'll still make the point. This PE looks very rational, looks like it's a good discounted stock. So that PE is not necessarily the conclusion of the analysis, but it just gives you a metric that you could say, is this worth, it's just one more metric. It's just one more data point. Hey, the PE seems low, and this is probably going to rise over time, especially if they keep growing their top line and becoming more profitable. Keep asking your questions and welcome. If you're new and you're young and you're investing in yourself by getting smarter about investing, you're going to have more money than you're going to need. So keep at it. All right. So Omar, NTR. Let's put that on the board. And just be patient. We've got a good number of stocks that have come up already on the live stream. So please be patient and we'll get through it. All right. So we talked about, and I noted Humana, Omar. I don't know if I mentioned that. So we got through Oscar and we got through United Healthcare. United Healthcare is having a bad day. So next one I'm going to talk about, it did come up, was we'll go Coin and Block, which kind of are similar. All right, so Coinbase is up. So the SEC was really going after Coinbase, and it is, the SEC was contending that, hey, Bitcoin and other cryptocurrencies are like stocks, and therefore we want more reporting. And Coinbase was arguing that no, it's not. It's not anything like a stock. A stock operates, revenues, and they put out financials. Bitcoin can't do that. You can't put cryptocurrencies in a category where they just don't fit. And the SEC, I think, was wrong. It's like, guys, this is a new thing. You can't put old reporting standards or regulatory standards on a new technology. You have to partner with whoever's leading that technology and figure out what is in the best interest of the market, investors, the country, everything. The SEC didn't do that. So, shame on the SEC. Instead of fighting something that is a great idea, partner with them and figure out what's going to be the best policy. So they dropped it. I think Coinbase for me is an investment in the future. It's doing great, up 52%, 5-year. This is one of these, we're going to see a lot of these stocks. Remember 2022, I said this was a big drawdown year where stocks really sold off, but this one came back. So when you see the return on this, especially like the 2-year return, it's really, really good. So Coinbase has a forward P of 35. They are growing really fast. They doubled their growth this past year. I think the Bitcoin was up, by the way. So crypto, Bitcoin, 99,000. This is a very good sign. I think as we saw inflation reports come up, it caused Bitcoin to go up in value. So that's good. So that I think it's a combination of Bitcoin's up and that SEC issue is off the table. And that's what's causing Coinbase to go up. I'm an owner of Coinbase and I don't think I'm buying anymore. I'm not buying any more shares because I own a pretty good number of shares. And when we look at I think it's discounted by 11% if I look at their cash flows and earnings per share. So it's a nice discount. If I didn't own any Coinbase, I'd probably buy it. But since I already own a lot of shares, I'm not buying any more shares. But this one would be, if it dips, like let's say it got to 20-25% discount, I'd probably buy shares. So that's Coinbase. And a similar company, Block, is so I forgot the symbol for Block. Is it this one? XYZ? Yeah, I think I'm on the right one here. Yeah, this is it. Okay, so Block is 42 billion. It's down 11%. Holy smokes. What happened? The CEO of Block, I think, was co-founder of what is now X, and then he's moved on to Block. Revenue 24 billion. Forward P is 16. It's not bad. It's supposed to be discounted by 31%. Year to date, it's down 14%. Over the 1 year, it's up 10%. Now, Block is they're a lot like PayPal, and I thought they were going to go big into crypto, but I don't think they did. They also have an app that competes directly with Venmo. It's the Cash App, and I think that has had good growth in users. So what's going on with Block? Let's take a look at their announcement in a bit. Let me just kind of get oriented. I haven't looked at Block in a long time. I'm an investor in PayPal, Coinbase. What else is similar to it? Robinhood. So I kind of have the horses within this area of the market, this industry and sector. I kind of have the horses I want to ride. So this one hasn't been relevant to me, but it looks like the revenue is already reported on Stock Analysis quarterly. Man, that is not good growth, fellas. I mean, when you look at Robinhood growing the way they're growing, and I showed you Coinbase doubled. It's like, guys, you can't put up 4.5% growth and excite the market. I think that's part of the problem, is lack of growth. And look at their growth in the last quarter was only 4.5%. So I think that's a situation there. That's a red flag. Why is your growth slowing down? Right now is not a time for financial services. You got really high stock prices. Crypto's going through the roof. Financial services doing great. So Block has got a lot of explaining to do. Why are you guys lagging? Cash flow looks very good, but at a slow growth rate, the best I could do is probably give them a value of like 30 billion before I either decrease it based on the net debt or increase it by the net cash, which I can look at in a bit. So this one here is not looking all that great to me. Let's look at their debt ratio, or excuse me, not their debt ratio, their their cash versus debt. So they have more cash than debt. So I think this business, based on what I'm seeing, is worth like 31, 32 billion, and it's priced a little too high. And I don't base it strictly on earnings per share. You can show earnings per share as a really good number. But earnings per share is just, I think revenue growth is very important. When you show it, it's like, hey, more customers are coming to the company. They're selling more products. They're increasing prices. That's all positive. And they're supposed to keep growing at around 10%. Their profitability is also going to grow. But you see their PE, it's just not a desirable business to investors, because I think investors see that there's other options that maybe look better. Robinhood, you have PayPal. I think PayPal is priced really well. It has a very good risk reward situation for me. So Block is a pass for me. I could see why investors are like, hey, this isn't the right horse for me. I'm going to switch to another investment. And it's been kind of interesting within this industry. I think Trade Desk has been a stock that was also sold off because they're not growing very fast. At the same time, some other brokerage type businesses or financial services businesses have really flourished. So the ones that are flourishing are getting the investment from investors. And I think that's right. It's kind of like, based on the performance of those companies, they're receiving more buyers, and they're selling out of companies like Block or Trade Desk. So that is Block. That's what's happening with Block. That's what's happening with Coinbase. Let's move over to, all right. So Shadow Guy wanted to see this company. I'm going to have to learn to speak Chinese on this one. And I think, let me check. So it's this one. So this one's in Hong Kong, and I figured out how I can buy into Hong Kong, by the way, Shadow Guy. So I do have a Moomoo account, and I'll be able to buy Hong Kong stocks through Moomoo. I made a note to myself to look into it. So this thing's up 5%. Jeez, man, up 300% in 1 year. Up 50% year to date. What do these guys do? So Xiaomi Corporation, an investment holding company, provides hardware and software services in mainland China and internationally. It operates through smartphones, Internet of Things, lifestyle products, internet services, and other segments. Wow, man. Incredible. So this is in HKT currency, and HKT to USD is so it's 0.13. So 0.13, that would be 130 billion plus that would be about $170 billion in market cap in US dollars. Forward P is a little high at 46. Okay. So the growth is not incredible, like 25% is good. Let's see the quarter if it's even better. Yeah, it's good. It's just not amazing. It's not like Coinbase up 100%, Nvidia up 100%. That's amazing. That's like, wow, man. That is, everybody stop your vehicles and look at this. It's up 100%. No, this is good. And it also had bad years like in 22, 23. So this is good, but not amazing. And free cash flow. And again, this is in the other currency. I think if I go and I use statistics, the stock analysis app converts this to US dollars for me. So let me kind of cheat and kind of go here. So no, it's still going to give it to me in HKD. Okay. They have a lot of cash. Wow. They really built up their cash. So they have about 15 billion US dollars in cash and about 4 billion in debt. So they about $11 billion of cash, spare cash, walking around money. So this one here, I'll have to do more homework on it and kind of ease into it. There are a couple companies that I'm interested in, but to invest in China, I've decided to keep it simple for myself, and I've invested in an ETF, and I've invested in Alibaba. The ETF I'm invested in is FLCH. And I think I'm going to keep to that plan because it's a little tricky to try to figure out, do I buy, PDD? Do I buy XPeng? I'm very comfortable with Baba, but I think this is the one that I'm very comfortable with. These guys own Tencent, Alibaba, this company. Hey, I already own some of it. So I already own some of it, Shadow Guy. Accidentally. PDD, BYD, these guys are crushing the automotive industry. JD, they're doing well. NetEase, Baidu. So it's invested in all those. I think that's what I'm going to keep doing with China. And I just started a position in Europe, similar ETF, kind of get my foot in the door and see how it does. Year to date, this is up 18%. So that's good. Over the 1 year, it's up 42%. So I think I'm making a good investment here. So I'll play this ETF with Baba. And that's my position in China. And I think that'll be a maintainable for me. So thanks for bringing this up. This company is rocking, just crushing it. Look at that, 298%. It's up another 5%. Man, whatever energy drinks these guys are drinking, keep at it. Very good. Thanks for asking about that, Shadow Guy. All right, so I see a lot of people have joined. Thanks so much. Good to see you guys. Let me see. I'm going to catch up on comments and then get back to it. That way I can cover all the stocks that have been brought up. And I know some of you in the past maybe put up a stock and I didn't cover it. I really apologize. I'm a one-man operation. Sometimes I miss a symbol here or there, and I really apologize. I don't mean to ignore you, or maybe I noted it and forgot to cover it. It's my fault. I apologize, but hopefully it doesn't offend you. All right, so Mohammed, how are you, sir? Very good to see you. Sergio, what's up, man? You're one of the regulars. What's up, buddy? Am I buying new holdings? Yes. And I did a video. You probably saw it. So, Mohammed. So, Rivian and Deckers. So, I just bought a car for my wife and I. And it's a very nice Mercedes, and we love it. But, man, if I might buy a Rivian, I think they're really cool cars. And then Deckers, which is the makers of the Hoka. I know a lot about Deckers. I'll tell you about it later. So I can cover both. Please bear with me. I've got probably 6 to 8 stocks ahead of that. So you're already in this stock. Attaboy. Nice. Yeah. And they're big in Europe. See, that's, I think, related to this stock is Apple. And Apple is a great company, but their biggest threat is that China's putting out really good devices, and so is Korea, that are far less expensive So if you're a consumer, and we all are, depending on the product category, right? But we're all looking for a good value. And I think Apple's biggest risk is companies like this and Samsung and others and Huawei around the world are putting out really good devices for really good prices. So these guys, not a big surprise, they came out with a device that is less expensive. Oh, look at that. Why? Because they're probably feeling the pressure that, hey, we're losing users to other brands because the other brands provide a less expensive device. Ta-da. So I think that's going to really affect their overall profitability in the future, because the lower the price, it might squeeze those margins. I think it's going to squeeze margins. So I thought I'd mention that. All right. And it looks like we are getting consensus. Joseph, good to see you again, man. Good quality phones. You know they're quality because Sergio said so. Shadow Guy. Yep. They do a lot more than smartphones. I saw that. Yeah. So they're into Internet of Things, lifestyle products, internet services, and other segments. Yeah. I mean, they're crushing it. They're doing really well. Very cool. So, Enkiter. Interesting. Yeah. And again, you guys can buy the stock direct, which is awesome. I got that ETF and it looks like I'm invested in this stock, and not I didn't actively make that decision. The ETF did, and I got it. Yeah, that's working for me so far. All right, back at it. Let's get back to the list here. So, I think I left off on symbol 4. So let's get back to symbol 4. 4 shift. Okay. So Shift4 Payments provides software and payment processing. Okay. So it's a payment processor. It's competing against PayPal. There's a number of them that are out there trying to capture this market. They're a small cap company, 8.6 billion, revenues 3.3, forward P is 21. Analysts say it's discounted by 19%. Year to date, it's down. Over the 1 year, it's up. Very good revenue growth. Okay. The revenue is good. As they get bigger, this number the percentage number goes down because this number keeps getting bigger. And the law of big numbers, it's hard to grow at the same percentage rate as your top line revenue keeps getting bigger. That is understandable. And when we look at their free cash flow, 391, it has grown over time. Nicely done. Gross margin, they're in a tighter margin business. It's more of transaction based, which is understandable. All right, so 391. They're growing at this rate. And we'll look at their balance sheet. So they have cash of 1.2 billion, debt of 2.8 billion. So if you take this number minus the cash, we're at 1.6 billion. So they're worth about 8 to 9 billion, and they're priced at 8.69 billion in my mind. So these guys are fairly priced in my mind. And I did that by looking at their free cash flow, which is roughly 400 million, multiplying it times 20, which gets me to about 8 billion. And I could say that, well, their growth is a little better. So maybe I take that up to 9 billion, maybe even 10 billion. But then I deduct the net debt, which was a little over a billion. So I'm back to 9 billion, 8 to 9 billion or so. So it's fairly priced. And when I look at a stock, if it's a very unique company, to give you an example, MetaSearch, right? They're the dominant player. MetaSearch is, I'm sorry, Google Alphabet Search. Very unique. They're dominant. There's only one. Okay, that's one case. But this company, Shift4, is in a marketplace where they have real competitors. They probably have 20 competitors that they're trying to outmaneuver, outperform. So they're not that unique. Having said that, that also affects my valuation. Is like, how strong is their moat? How powerful is this company? So this one here is a pass for me. I think they're fairly priced. I don't think this is going to be a home run in 2025. I think they had a good year. They've had a very good 5 years because they've grown really well. So if somebody invested in this back here, congratulations. You're doing great. Even right here, man, you went from 32 to 97. So you crushed it. Nice job. I'm just looking at the numbers saying I probably have a better risk reward ratio in PayPal. And PayPal is more diversified. It's better known. When I look at PayPal, it's 75 billion, but the forward P is lower. They are growing, not as much because they're much bigger. Their platforms are really entrenched. A lot of websites use PayPal. That's their payment method, and that they're very entrenched in their marketplaces. They're also coming out with their own cryptocurrency. They have the Venmo app, which is very entrenched in people's behavior. So I like PayPal in this space. I think it has a very good risk reward. It's down 1.8 year to date. It is down 10%. For the 1 year, it's up 29%. So I bought shares in PayPal yesterday, by the way. I might have to buy some today. What's the market doing today? Now that the market's open, let's take a peek. It's a down market. Oh, no. Dow is down 0.83. S&P down 0.32. NASDAQ down a little bit. Russell is in the green, just barely. And I think for the week, this is a shorter week. We didn't trade on Monday. So looking from where we started, the S&P will finish the week in the negative unless things turn around. Unless stocks start to rally, it'll be a losing week. And especially 2 days ago, I mean, stocks really fell off, almost 1 percentage point on the S&P. So let's see where we end up. All right, so that was 4. And let's take a look at Booking. Did somebody ask for Booking? I think so. So Booking, I think they announced they're up 4%. That I expected that because Airbnb announced last week, and they had a very good quarter, and the market really liked it. These guys are have a higher market cap than Airbnb. They're also bigger. Market cap of 172 billion and 23 billion in revenue. Forward P looks pretty reasonable at 24.75. Analysts think it's fairly priced. And over the year to date, it's up 5%. The 1 year, 41%. 5 year, 165. Very good. And we compare these guys to Airbnb. Airbnb is down today. Interesting. They're smaller revenue, higher PE. So they're growing nicely. Booking is also growing nicely, about the same rate, but they have a bigger number. So this is more impressive. bigger number. And they really did well in Q4, 14% versus the quarter prior was 9%. Looks really good. Nice job booking. So overall, Booking has outperformed Airbnb. And I'm an Airbnb stockholder. I thought I was picking the right horse when I picked it. But the market said, nope, we like Booking. We think Booking's better. And the market was right. Over the 1 year, Booking's up 39, where Airbnb is just barely nudging a small return. And year to date, Airbnb is doing a little better, but I think it's a case of it did so poorly in 2024 that it's doing a little better year to date. But overall, Booking wins the battle between these two travel stocks. I do think Airbnb has a true kind of born in the sharing economy kind of business model, which is really cool. But Booking has better diversification. They're diversified across different aspects of travel. Not only do they do housing, they'll rent you a car, get you a flight, and that I think matters. I think that diversification is helping them grow faster and get bigger. So good job Booking. They're doing great. Am I a buyer? No, I'm not a buyer in Booking or Airbnb right now. I think the stock's done well. My concern is that travel is going to do well when the economy is doing well. Our friends at Walmart said the consumer's getting nervous. They're not going to spend as much in 2025. That inflation's eating up their budget. And that can't be good for travel. So travel, I think, is going to have a flat or maybe a contracting year where people are like, okay, we're not going to travel as much in 2025. We're going to save our money. You're having a lot of layoffs. Biggest layoff, I think, in the U.S. federal government history. They're trying to lay off like 10% or some really high number, as well as corporations have announced layoffs. And as soon as that type of news hits, the business community, people begin to be careful with their spend. Hey, I don't want to travel as much. Maybe the vacation I planned isn't going to be as expensive. I'm going to maybe tighten the budget on my travel. So I think that's going to be a strain on both Booking and Airbnb. I'm actually selling some of my Airbnb shares. I am holding them at a gain. And that's one of the places where I'm building cash, is I'm just lowering my Airbnb position by selling some shares. So that is Booking. Thanks for bringing it up. Any comments on Booking? Yeah, have a good evening, Shadow Guy. Thanks for joining. All right, so I'll keep rolling. I see some other comments coming in. Please be patient. I'm trying to get through a list of stocks that we're analyzing, seeing what's going on with these stocks. And I think one that was brought up was Sprouts. Wow, holy smokes. 13% drawdown. So one of the things that, I was really impressed with how this stock appreciated. This is the grocery business. I own Kroger, and it's been a nice, steady upward trajectory on that stock, but nothing like this. 176%, 821%. This is a grocery store. $14 billion company, revenue $7 billion. And the reason that I kind of laugh is when you look at, okay, they're growing, but not incredible, right? We saw a couple of companies that were like 30% growth, 35% growth. We saw Coinbase at 100% growth. And these guys are at 12.9, which is above the industry norm, right? And they even had good growth in this quarter they just announced. Now, part of why Sprouts is growing very consistent like this is they are opening new stores, which is kind of a different I think it's not as impressive growth as you have the same number of stores and you improve the amount of same store sales. That's impressive. But when you open new stores, of course, people's curiosity is going to be, hey, I'm going to go shop at Sprouts. Check it out. Like I've been in a Sprouts. I think it's pretty neat. But our probably two places to get food are Kroger, Ralph's, and Trader Joe's. And once in a while, we go to Costco, especially around family events. Like if we're going to host a party, we go to Costco, right? Can't go wrong with that. Or if we look for certain items that Costco is just really good with, boom, go to Costco. And of course, I spent a couple $100s. It's hard to get out of Costco without spending a couple $100. So, but when I go to Trader Joe's, I mean, I can get in and out easy, fast, go pick up, something to make for dinner. Boom. Trader Joe's. Sprouts is a lot like Trader Joe's. So this growth, I think, is for new stores have been opened, which to me isn't as impressive, but that's me. Now, the market's selling it off. And I think part of it is that this is a low margin industry. When we look at their margins, gross margin of 38, profit margin of less than 5. So it's like, whoa, that's not great. The stock is up 800% on an industry that is super competitive. You think about grocery retail. I mean, you got mom and pops, you got farmers markets, you got big giant companies, you got companies like Walmart getting into the grocery biz. And they're huge in grocery now. You got Target getting into grocery. You got, of course, Amazon's into grocery through Whole Foods. And then they have that other, I think it's Amazon Fresh is their retail store. So you got massive competition, which is why I was so surprised and impressed that our friends at Sprouts were doing so well. I mean, they're going to grow to a certain size and then they're going to stop. They're going to be like, okay, we hit a wall. What does that wall look like? It looks like Amazon and Walmart and Target and Kroger and Trader Joe's. And that's a pretty big wall. So I'm not a buyer in Sprouts because I thought at some point the party's going to end and then the stock's going to get crushed, excuse me. And today is a bad day for them. Maybe they're beginning to guide that, hey, growth's going to be harder. Even if even if they grow stores, they still have to compete against those giants. So when I pick an industry that I really like, I like to pick companies where they're monopolies. Let's just put it out there. If you can pick a company that effectively is a monopoly and they got there by having the best ideas and they're so good, they eliminated competition because they're so good. Amazon, obsessed with the customer. Now they're the highest revenue company in the United States. I think maybe the world, but they beat Walmart now. They did it because they worked their butts off. They have the best e-commerce platform on the planet. Okay. That's a monopoly. And they got there the right way, which is they just did everything better than their competition. That's what I'm looking for. Sprouts is never going to be that. No, they have to contend with Amazon. They have to contend with Walmart. They have to contend with Costco. They have to, I can go down the list. You're going up against really, really strong competitors. And at some point, you're going to hit that wall and it is not going to be pretty. Moving on and moving forward, let's talk about Lenovo. So Lenovo, it looks like it's traded in a foreign exchange, which is why I was like, I haven't looked at Lenovo. So these guys are crushing it. What's going on? They announced yesterday. Announcement was good. I guess PC sales are better. This is on the Hong Kong currency, which is 0.13. This is roughly, so 13, and then that would be, this is about 22 billion in market cap. Wow, that revenue number is nice and big. Forward P is 16. So they are growing. So it's, what I'm glad you brought this up because I own HPQ, and Hewlett Packard is most definitely in the PC market. They're catching a little bit of a ride up, and these guys, we'll take a look at it in a minute. So Lenovo's growing really well. Nicely done, Lenovo. One of the one of the points that I make, and you probably heard it on my videos, is, why do I think China companies are going to be more valuable or are really discounted? They take a certain idea, in this case here, laptops and, computer devices and so forth, and they just put out a very good product. Here's an example, right? So when you do that, your consumer is happy. They get a quality product for a better price. And that's what they do. So you think about around the world, Lenovo's being sold everywhere: US, Latin America, Asia, Middle East, Africa, Europe. So they're doing really well. So the same thing I could say about the car industry, automotive industry. I think Chinese cars are going to do really well. See what they're doing with PCs, and they make all the phones. You look at AI, of course they're going to be good. They're very good at technology. So that's a broader discussion, but I tip my hat to Lenovo. They're doing really, really well. Now, the thing I don't like about hardware is it's not overly profitable. And when we look at their free cash flow is very good. This is in the Hong Kong currency. So this is roughly $270 million, excuse me. Gross margin 16%, really light, 16% gross. Profit margins of less than 2%. So that's why I don't like hardware. I'm careful not to buy too poor of a stock. Our friends at Hewlett Packard, this stock, what's it doing year to date? It is up, 7%. It is up for the year, pays a nice dividend. So this is a nice, boring technology stock. They are growing a little bit. They're not growing like Lenovo. Lenovo is growing much faster. These guys have better margins and they have better profitability than our friends at Lenovo. And they are a $32 billion market cap company. Lenovo was, so this was about 22 billion market cap. So it's similar to my comments on the other Chinese company that's traded in the Hong Kong exchanges. I'm going to invest in China through that ETF I mentioned earlier, as well as BABA. And this one here, I mean, my hat's off to them. They're doing great, but they're probably in that ETF that I bought anyway. So congratulations, anybody who owns a stock. I mean, you did really well. You took the elevator up from $9 a share up to 13. Boom. Nice. Hopefully that was the person who asked about this stock. He put some money down and is 40% wealthier on this stock. So congratulations on Lenovo. NTR. Nutrien. Nutrien provides crop inputs and services. It operates 4 segments: retail, potash, nitrogen, and phosphate. Okay. 26 billion in market cap. Revenue is 25 billion. Year to date, up to almost 20%. All right. So remember, we were talking about materials companies, right? Materials. And that this is the number one sector. And this one makes sense to me. These guys provide an input into farming. And of course, we need food. So farming is going to continue to be a thing. Now, for the 1 year, this might be an interesting stock to deep dive in here. Forward P is 14. And let's say it's a bias discounted by 10%. When we look at the revenue, it's down, but when we look at the quarterly, it's also down. So it's interesting. The market is bidding up the stock, even though the business is contracting. and it contracted substantially from 22. I guess the expectation is that food prices have been going up. I know eggs are tracked really closely, and like egg prices are really expensive right now. So, um, so free cash flow 1.5 billion. They're not growing, which is kind of weird that the market's bidding the stock up. Gross margins okay. This is a material company. So even if I use, let's say, the 3-year average, so this is 6, 8, 10. So let's say the 3-year average is like 3.3 billion. And I multiplied that, since they're not growing, by 10. Yeah, I mean, you can see that this stock may appreciate a little bit on you, but I'm not looking for a little bit of appreciation if I'm in a stock. I want this thing to double over 5 years. This one, I don't believe is going to double for me in the next 5 years. I think they've done well year to date. Material companies are doing well, but I just don't feel like this is going to do it for me. This is going to double in 5 years. It's not. I don't think that. So it's a pass for me. I don't think the fundamentals support this valuation. I think they support it and say it's a fair price. But then I look at, okay, is this industry going to go up in substantially in value over the next 5 years? And the answer is no. So it's a pass for me. Thanks for asking about it. I've never looked at that company. Next one is going to be Humana. Humana has been doing well. It's a health insurance payer that has had a tough couple of years. You see that it's really been sold off. But year to date, it's up 2%. 1 year down 29%. And I thought that they had been doing a little bit better, but I'm wrong. So they're only up 2% here. It's a $31 billion company, but I see a lot of value in Humana every time I see it. There's a lot of value in healthcare. I know that the industry, or I guess investors, believe that the new administration is going to really go after healthcare and try to reduce. A couple of things is the leader of the health department for the US, he's more into like healthy living, eat right kind of guy. And he may really push back on excessive pharmaceuticals. I think he didn't believe in vaccines, that kind of thing. And I think he may put a little stress on companies like Humana. And of course, the US federal government's trying to cut costs as well. So they may cut back on benefits to people. Don't know. It's just a guess, an educated guess on my part. But this is a small cap compared to like United Healthcare, which is 400 billion or so in market cap. This is only 31 billion, but it has a lot of revenue. Forward P is only 15. Analysts say it's a hold, but it's discounted. And when we look at this stock, it's growing. So this is what's kind of a paradox, or it's hard to understand why is the stock sold off so bad when it's growing its revenue. Look at the quarterly. Its quarterly is right there with the annual growth rate. And when we look at free cash flow, it produces free cash flow. It's growing. So this business is worth 40, 46, $50 billion, and it's only priced in the 30s. So this always looks good to me, but there's a lot of good choices within healthcare payers. I'm buying into Elevance. Oscar looked great. We saw that earlier. And even CVS, that has a health insurance paying business, as well as a retail pharmaceutical business. It's looking good. And this one's being sold off. What's going on with Oscar? Is Oscar selling off, giving me an opportunity to buy today? Come on, Oscar. Nice. Here's the opportunity. Boom. We got to pounce like a tiger hiding in the forest. Boom. Got to get all over this. It's going to be one of my first buys when I get done with my live stream. All right. So these guys always look attractive, but they're amongst an industry where there's a lot of attractive stocks. So you have really good things to pick from. And we saw that. Let's take a look at the heat map real quick. So here's the heat map of trading today. We saw that healthcare Like this is working. United Healthcare is taking everybody down. But this as a whole sector has been working in 2025 and it's been discounted 2 years in a row, 2023, 2024. This didn't do all that great. So the prices are low, stock prices are low. So it's an opportunity to pick up really good companies that I think are going to do well in 2025 and 2026. So that's one of the backdrops to considering Humana, considering Oscar, Elevance, or even United Healthcare is the industry has been beaten up and it's going to come back because they generate really good free cash. They grow their businesses. Healthcare insurance is a necessity. It's not a, hey, only 1 out of 100 people want healthcare insurance. No, 99 out of 100 people want healthcare insurance. They really value it. So Humana is a good idea. It's just, you got good choices. So make a good one. Make a good choice for yourself. I think somebody want to look at, did somebody want to look at M? I don't remember noting that. Let me check on comments real quick and then we'll get back into it. So Joseph's, okay. So I think Nicholas, thoughts on Uber and Lyft. Yeah, we can get into that. I'll put it on the list and then we'll come back to it. And I don't know that anybody ordered or asked. Yeah. Okay, cool. All right, let's get back to it. Mike, Oscar isn't down near enough. Yeah, love your style. Love your style. Give me a great deal or no deal at all. All right, Rivian. These guys make cool cars, really interesting. They don't have a lot of units, and they also produce a commercial vehicle. And I believe the company produces their vehicles and they sell them to Amazon. So that's kind of a really good situation for them. And Amazon is growing their ability to deliver packages. So it's a very good place for them. It's a $13 billion market cap company. And when you look at the chart on this thing, what's interesting about Rivian is they had, back when they had a really crazy valuation up here, they had delivered 50 vehicles. And when they IPO'd, they were the second most valuable company on earth. And it's like, what? Number one was Tesla. Number two was Rivian when they went IPO. But the reason I don't buy IPOs is because I see this happening too often. The IPO price is too high. You can study Google Alphabet. You can study just about every stock. It sells off. So I didn't buy it when it came out and boom, it sold off big time. But over year to date, it's not doing all that great. I mean, this business is not doing great for the shareholder. Today, it's down 6.5%. I thought the news would have been good that they're going to start to turn a profit. I think the reason for it is that they guided that they're not going to sell as many vehicles in 2025, which is a big bummer. Their revenues and all that, not that great, 12%. It's a small number. The automotive industry is super competitive. And now you have the Chinese coming out with great EVs. It's like, man, good luck. It's going to be tough. They just burn cash. Look at that cash burn. Whew, that's a lot of cash. It's a lot of cash that's been burned. And they don't have any free cash flow coming. So this one here is a total pass for me because I don't like the industry. I think the industry is too competitive. Remember a statement I made earlier is I want a monopoly. I want a company that's so good. All other competitors have failed because that one company is so darn good. Rivian is not near that. Like Tesla can start arguing that, hey, we're so good in EVs. We're the preferred brand. I think they can make that statement. But Rivian, I think, is kind of for the consumer, it's kind of a obscure brand. And now the other brands are coming out with awesome EVs. Toyota, Mercedes, Ford. I mean, these car companies are coming out with great EVs. And I think that's where Rivian is gonna have to contend against. For example, the The Hummer was brought back by GM and they electrified it. It's a pretty cool looking car. And I think a consumer has to pick between a cool looking Rivian or a cool looking Hummer. It's like, wow. Well, there you have it. Competition. So these guys, yeah, I'm not a buyer. It's just the industry is not good for me. The growth in 25 is supposed to be pretty slow, and then they're supposed to start growing again, which is interesting. Maybe their commercial business is going to get bigger. But I pass on this one. I mean, it's been a tough road for investors, and I'm not a buyer in Rivian. Maybe Amazon will take these guys over just to make sure they get all their vans delivered that they're going to need for their delivery business. So that is Rivian. The other one you wanted to cover was Deckers, and they are really doing well with that Hoka brand. They're down a little bit today, but year to date they are down. Whoa, up 4%. They were doing great because they were growing their shoe sales in large part because of the Hoka brand, and they really nailed that acquisition. It's still a small cap compared to Nike. Nike's around 100 billion. These guys, their revenue is 4.9 billion, forward P of 23. They're discounted by 46. Now, these guys are in a low margin business, and you could see that the market's like really afraid of them now because once you've sold Hokas to a certain segment of the population and competition's caught up, the Hoka brand really did well because they're originally made for ultra marathon runners, so they're super comfortable. Well, the other brands are caught up. Adidas, Nike, and everybody else is making a like shoe product. So now Deckers is competing against those other brands and having to lower their prices and just more competition for that shelf at the athletic footwear store. So these guys are growing their revenue nicely. Quarterly still looks good, but I think they're guiding that, hey, it's going to be a little harder. It's going to be a little harder to grow in the future. And their cash flow is pretty good, $1 billion based on their growth rate. Let's see what kind of debt they're carrying. Now they have a nice cash surplus, $2 billion of free cash just sitting there on the balance sheet. They're fairly priced in my book. They are fairly priced. You know, it's an exciting company. If they can keep growing, they're fairly priced and they should give the investor a reasonable return. Part of, I think their gross margins are very good for being a consumer discretionary product company. And they're growing nicely. So fairly priced. If you like the company, there you have it. They're offering up a nice discount. The stock's really sold off. So I think investors are a little scared. So we'll see what happens with Deckers. For me, it's a pass. I own Nike, and my Nike investment hasn't been all that great. It's been okay, but I'm not looking for okay investments. I'm looking for really good investments. And these guys they're down a little bit today. Year to date, they're up a little bit. 1 year, they're down 25. I did not buy a year ago. I bought certain times, and I'm sitting, I think, on a small loss. But I'm expecting Nike, if they bounce back, they're going to bounce back to closer to $150 a share, maybe up to $100, $120 a share. I'm expecting that bounce over the next year to 2 years. They're $114 billion market cap. Of course, we all know who Nike is. They just have to repair their business. They have to start growing. Deckers is a smaller company, and they have a variety of certain styles of shoes. And their hottest one is the Hoka brand. So we'll see how it goes. We will see how Deckers goes. Looks like their stock for year to date really getting corrected, and not a lot of momentum in their space. And I made an earlier comment where Walmart said, hey, the consumer is beginning to get strained, like they're seeing that inflation's really taking away some of their discretionary budget. Well, this is all discretionary. Deckers doesn't sell like low-cost shoes at your local, discount retailer. These shoes are all expensive. Like your Hokas are a couple $100. You're looking for that consumer that can spend a couple $100. So I think that's going to be a problem for them in 2025. We'll see how it goes for them. Thanks for asking about Deckers. All right. I think I'm going to get caught up on the list once I catch Uber and Lyft. And both are stocks that I'm a buyer on. And the space is a space that I like. And I'll tell you why. All right. So starting with Uber. Uber is down a little bit. Year to date, it's up nicely. Go Uber. For the 1 year, you see that the market's given us these really nice discounts. Hey, I'm discounting Uber. Blue light special on aisle 5. We're selling Uber shares for $58 a share. And boom, I bought them. And then right here, hey, another special on Uber stock, $59 a share. Boom, I bought them because it really rose nicely. So Uber is a very valuable company. We talk about, companies that resemble a monopoly. Uber is becoming that monopoly in ride sharing because they're so darn good. They are dominant. They have distanced themselves from their competition like Lyft and other, players. So Uber is going to continue to grow. They grow nicely, very nice growth on a very big number. They can grow without having to put capital in their business because the drivers themselves get the car. They come and drive for Uber. They don't have to hire employees to grow because the drivers are independent contractors. So it's a very good business model, and they're going to keep their margins. They're going to keep getting more powerful. I think they're going to harness the robotaxi paradigm as robotaxi becomes a thing of scale. Because right now there's no scale in robotaxi. It's all stories. But when it becomes a big thing, I think Uber is going to be really in a position to take advantage of robotaxi. And rather than having humans driving the cars, they'll have robotaxis, and they can buy them or they can partner with a technology provider and then have robotaxis pick people up and drive them around. So I think Uber is a fantastic investment for me. I'm up nicely on my investment. And the other company that I think is going to do well is Lyft. The reason Lyft is going to do well is the valuation is tiny compared to Uber, 168 versus 5. Wow, that's like no valuation. The stock's been sold off. It hasn't kept up with Uber, but if you look at the revenue growth, that is fantastic growth. We're talking about very good growth for the last 4 quarters. I really like that. So this growth combined with a very low valuation, and you think about a bigger company that wants to be a player in robotaxi or maybe even we talked about booking Airbnb earlier. It would make a lot of sense for either one company to acquire Lyft. And then they can offer rides on the booking platform or the Airbnb platform. When people go to an Airbnb, oftentimes they're traveling there and then they need a car. Boom. Or they don't rent a car. They need to be driven places. When I travel, I really prefer using Uber or Lyft. And because when I'm in a foreign city, it's a lot safer to have somebody who drives those streets every day drive me around, especially when I go down to Latin America. It's really affordable. So it's a win-win. So I think Lyft is an opportunity to get a really discounted stock in a category that I think has a very bright future. So that's why I'm buying into Lyft. Lyft is discounted. Both Lyft and Uber are discounted. Let's take a look at the discounts that I have on Uber and Lyft. So on Uber, I have a 68% discount, which is a good discount on a good business. And part of it is that the market's been selling it off. But on Lyft, it's just even more exaggerated because they produce really good free cash flow. But their stock price is so darn low. It has a very low valuation when their free cash flow is worth that much. And I showed you the growth of the company. They're growing 30%. Like, man, that's really good growth. So I'm a buyer of Lyft and Uber. All right. So that is that. Thanks for asking about Uber and Lyft. All right, so we talked about there, Omar. I wish Carhartt was a public company. Yeah, it is a very good, popular brand. I agree with you. I own a few apparel items from those guys. Mike, the dividend investor guy. Interesting. Cool. So let's see here. What's going on with the stock market? Looks like it's selling off. All right. Well, at least the market picked a direction. It's going down. All right. So Meta's up a little bit. All right, Meta. Enough of this, red. It's nice to see a little green on Meta. And Google's down again. Tesla's down. The bigs are down. Okay. Looks like pharma's still working. Banks are bouncing back. Beverages are doing okay. Okay. Looking at industries, energy's on top, industrials, technology. Wait, looking at backwards. Everything's in the red, but financials is doing the best. Technology, second place. Healthcare is second place. Technology in third. So it's a matter of who's the smallest loser. And here we've got the big players. Apple's down, Nvidia's down, Microsoft's down, Amazon's down, Google's down, Meta's up. So of the top 9, there's only one that's slightly in the green. Everything else is in the red. All right, good solid red day. Good opportunity to buy a few shares. I like when the market gives us a direction. And I'm gonna stop there on the stock reviews. I'm gonna need to get going. We're 24 strong in the live stream. You guys are awesome. Thanks so much for tuning in. Thanks for all the good questions. Omar, if you want to come back next week and ask about GWW, that'd be great. Trade Desk, I mentioned earlier, they've really been sold off. I think their growth rate's a little concerning, but you're buying into it. I can't argue with that. I think Trade Desk generates a lot of cash flow. So a lot of free cash flow and profits. So good luck with that. All right, everybody. Thanks for tuning in. You guys are awesome. Let's see how the market closes this week. Let's see how we can preserve and grow our wealth in 2025. I think it's going to be an interesting year. Let's get ready for it. Each day, get a little smarter. Find a couple new diamonds in the stock market. So Mike and VO is up. U is up. Oh, man. I'm out of U right now. REITs are up. Yeah, good deal. All right. Awesome live stream. Everybody have a fantastic weekend. And I will talk to you soon. Take care.